Now, bond yields across the world are going up, but just let's try and underline as to just by how much and what is the kind of impact that that has. So let's unwind through the last couple of weeks and let's take the US 10-year treasuries to try and understand just how much the bond yields have gone up by. So last week, we'll start off with bond yields were just below the 1.3% mark. This is the 10-year US Treasury bonds, right? We're at roughly 1.3%, in fact below 1.3%. Last Wednesday, on the 22nd of September, the yields rose by a bit, around 2 basis points or to around 1.32% before the start of trade. End of last week, that is the 24th of September, it was at the 1.45% mark, which topped the 1.5% mark at the start of this week and went past the 1.567% mark on Tuesday. So what we've looked at is a rate which is the highest yields since June of 2021. To give you some context, the rise over the last 2 weeks is almost a 20% plus rise in terms of bond yields only over the last 2 weeks. And this is broadly across the world. We've seen rates from Indian government treasuries across nations, rates are going up. And this is obviously partially driven by the Fed commentary. Of course, the Federal Reserve last week did express some amount of concern over inflation, as well as gave some commentary on the fact that they will be tapering their $120 billion a month bond buying program, and obviously that will also mean liquidity withdrawal. However, more importantly, let's focus on the inflation piece of it. That is one of the drivers that takes bond yields higher. Now, markets, of course, are convinced that there is an energy crunch in China, which will create greater impact on commodity prices. And commodity prices will get impacted more than the real demand that is essentially being created. So, of course, there is a supply side crunch, which will drive commodity prices higher and inflation higher as well over a longer period of time, which is what is really impacting bond yields, one of the main reasons why bond yields may be impacted. Now, what is the impact of bond yields increasing or bond yields going up, right? Of course, the first impact will be on tech and platform companies. So what we saw on Tuesday was a virtual sell-off. You saw Amazon, Microsoft, Alphabet fall over 3% in trade on a single day only on Tuesday. Why has that happened? Of course, tech-based stocks went higher during COVID as interest rates went down. Tech-based stocks went up. This is a simple discounting formula, of course, but it's a lot more complicated than that. Growth stocks are always better impacted when bond yield prices go down because they are essentially growth stocks, right? They provide higher yields, they de-risk or they absorb some of the lower bond yield rates, and hence they absorb a lot of the liquidity which is there in the markets. And that's exactly what had happened. Now we are seeing an unwinding of that. Due to the spike in bond yields, there is a normalization wherein the old economy sectors are coming back and adjusting themselves in terms of valuations, and tech valuations will start falling. So valuations, of course, will get challenged given the fact that discounting rates, which are linked to risk-free rates of returns, which are linked to bonds, are going to get challenged. And there is going to be a transition or a change of leadership of sorts. The volatility will continue. In fact, it has just about started, which is typically termed as a rotation rally, where other sectors like energy and essentials may start playing a bigger part in this particular rally. So interesting times ahead. Keep a watch out on bond yields, and let's see if the rotation rally does play out.